What's up, everyone? It's Karthik with MoneyVest. So markets here selling off. Both the S&P 500 and the NASDAQ were lower on the day, with the Dow Jones is slightly higher, about 9 basis points. So very, very flat day in the markets. The NASDAQ down about 30 basis points, flirting at just over 17,000, with the S&P 500 at just over 5,500. Right now, the market cap for the S&P 500 collectively for all the 500 companies sitting at just over $48.7 trillion. And we did witness an $86.6 billion of additional sell-off on the day today after seeing over $1 trillion worth of losses and market cap getting erased from yesterday, and 100% contribution margin for Magnificent 7, because we did have over an $87 billion sell-off in the Magnificent 7, and NVDA taking the brunt of that pain once again, down almost $44 billion as it was trading down to $106.21, down about 1.66%. I'm actually planning on rolling out my option, both up and out for this option contract, because the put that I sold last Friday is already in the money. And, since it's trading at $106.21, so that will be sent out either tomorrow on Friday, depending on how NVIDIA trades for the next couple days, especially on Friday, since we have the jobs report coming out. Unemployment rate's going to be coming out in the first Friday of the month. So I'll most likely be selling another, basically buying to close the existing contract and then selling a new one. In other words, rolling this contract both up and out for NVIDIA. So that's going to be sent out in the Discord if you want to get access to my entire options portfolio, as well as the real strategy and what options I'm trading. Link's going to be down below. I actually ended up selling a covered call on Tesla today as well and collected just over $300 in premiums. And all the other updates, including our MoneyVest dashboard, volatility levels, engaging with over 1,000 traders and investors globally. We'll love to have you on board with 4 more spots left, and there is a 16% annual discount that's also available. Now, coming over to the S&P 500, and if you come take a look at the stocks that were selling off, of course, NVIDIA was at the top of the list, and we had Amazon, Apple, Eli Lilly, Google, Advanced Micro Devices, Verizon, ExxonMobil, Chevron. So energy also took a pretty big hit. Exxon, Chevron were down anywhere from 1.2 to 1.8% because of the significant selling pressure in oil. So if you come over to crude oil, continues to break down below a key area of support. It is now sitting at under $70 a barrel at the moment. So that is something to keep in mind, as it's going to continue to put more and more impact on energy companies, energy stocks. So they were all down. You'll notice Devon Energy, Chevron, BP, we got Occidental, Shell, Valero, we got ExxonMobil, Marathon Petroleum, anywhere from 1.8 to as much as 2%, 1% here on the day, as oil prices continue to come down, which is actually going to be a good thing for inflation readings in the future. Now, Joel's numbers came out at 7.67 million job openings, which was significantly lower than the consensus of 8.1 million. So what does that actually mean for the economy? If you come over and if you plug in that number on our spreadsheet for unemployment, so let's just go ahead and update this number live. So we've got 7.673. So we're going to plug that number here, 7.673. And now, based on the job openings and the unemployed persons, you can actually get this number from the BLS website as well. So if you come over to bls.gov, you can take this number on your own and come over to the national unemployment rate and come over to the charts. Let's just go over here, read more. And this is going to bring up the chart. This is the current unemployment rate for the United States. As you can see, that we've been kind of trending upwards a little bit slowly and steadily. We've gone from about 3.5, 3.4% to now sitting well over 4.3. And that's exactly what we have calculated on our spreadsheet. This is nothing but a calculation based on the unemployed persons divided by the participating population. And this is a comparison going back as far as the pandemic, the great financial crisis, the dot-com bubble, and the great inflation of 1970s. And in the past, as you can see, the population increased from 226 million to well over 332 million. And the participating population has been more or less in and around 60%. Right, of the total population, and that's gone from 105 to as much as 166 million people that are over the age of 16 and also eligible workers that are actively looking for employment in the United States. And this is the unemployed persons. Now, in the past, at 7 million, just given how the population size is now much bigger, we are at 4.3%. But anytime in the past, a 7.16 million population, unemployed persons population, would have already triggered some type of warning signals in the US. And what I mean by that is, for example, if during the Great Financial Crisis, we were already at 7.16 million, we'd be looking at 4.7% for unemployment rate. So we'd be 40 basis points higher than where we are today. Back during the dot-com bubble, 7.16 would have put us well over 5% in the unemployment rate. And during the great inflation of 1970s, a 7.16 million unemployed persons would have put us almost at 7% for the unemployment rate. But because of the larger population size, we're still at 4.3%. Now, if you come over to this right here, civilian unemployment, this is a number that I'm referring to, and this is exactly what I'll be watching very closely on Friday. So remember, Friday is when the numbers come out. Joel's numbers came out today. Tomorrow we've got the initial jobless claims that come out every Thursday, ADP non-farm payrolls, and this right here, the employment situation on Friday, September 6th. I'll be live to cover those numbers at 8:30 a.m. Eastern. And this right here is the consensus. 160,000 jobs added in the month of August, according to markets expectations here. 4.2% is the unemployment rate expected to come down, and 136,000 in private payrolls, with construction and manufacturing coming down about 2,000 jobs in the month of August. And our focus, like I said, is going to be very much on this number here, which is the unemployed persons, right now sitting at 7.163. That's exactly what we have here, and that is 7.163. And the ratio, which is the job openings to unemployed persons, has now normalized down to 1.07. At one point, this number was well over 2.5. The Federal Reserve Chairman Jerome Powell has mentioned this time and time again in previous updates and press conferences, that this is a very tight labor market because we had over 2.5 job openings for every one unemployed person. And now it has come down to an equilibrium of one job opening for every one person that's looking for a job, right? So unemployed persons to job openings is very close to 1. So that's a 1-to-1 ratio of job openings to unemployed persons. Of course, there's a big mismatch because the job openings may not be matching the unemployed persons because of the mismatch in skill level and the different education and the degree requirements. But that is where we are. And that's exactly what the Federal Reserve's goal was, to try to achieve an equilibrium for the labor market where both of these numbers start matching. And that's where we are. So 4.3% is where we're at. And if unemployed persons accelerates further, so we've already got job openings coming down, but if unemployment persons starts to go up now, let's say that it goes up to 7.5, now we're getting this number close to 1.02, so as close to 1 as possible. And then of course that's going to result in unemployed rate also going higher, which is going to once again elevate some of those fears around a recession over in the US. So very, very important numbers coming out later today. So stock market today, S&P 500 slips as NVIDIA rebound runs out of steam. So down over 1.6%. At one point, it was higher, 1.5% on the day, but of course, selling right back down. And job openings fell more than expected in July to 7.67 million from a downwardly revised 7.91 million in June, pushing the ratio, so this is the exact ratio that I just showed you guys, of vacancies to unemployed to 1.07, which is exactly what I have over here. And then today's report adds to the body of evidence that labor market is not only looser than pre-pandemic, but is continuing to cool and potentially now at a faster pace. And NVIDIA rebounds also fading. As Bloomberg News reported, the company had been sent a subpoena by the U.S. Department of Justice as part of the deepening probe into its artificial intelligence chip market dominance. Zscaler was down over 18% after earnings. We talked about that on our in our previous videos, and of course in our earnings calendar. If you come over here, Zscaler, despite the beat on both revenue and EPS, definitely selling off quite aggressively here, down over 18%, down to $157 per share. After hours, it's kind of stabilized a little bit here, but definitely a pretty significant sell-off after the numbers were reported. And Broadcom is reporting on Thursday, which is also going to be a very, very important day for the markets. I will be live for Broadcom's earnings as well. So coming over to the Magnificent Seven a little bit more specifically, so you'll notice that we are currently down a little bit over 12% for Mag 7 collectively. Something that we have discussed in our previous videos that, once it actually is down a little bit over 10%, we tend to see an average and median sell-off of over 19 to 23%. That's exactly what we witnessed back on Monday, August 5th, as the selling pressure accelerated further. And right now we're down a little bit over 12% because we didn't really get back up to all-time highs. We recovered a little bit. So if you come back over to this, you'll notice that we did see some momentum back higher. And, at one point we were down about 8% from all-time highs, but then that selling pressure reverted back to the downside. We're accelerating further after breaking down certain support levels, and we are now down over 12%. So this is where we are. In a correction. The Magnificent 7 index, which we have created on our trading view, is in a correction well within the 20% range of its all-time highs. But if it accelerates further, then we're going to be going from rare to rarer to rarest occasions here for the Magnificent 7. The lower it goes, the better the risk reward becomes, right? So the lower the prices come down to, the lower the risk also becomes, and the higher the reward potential. Always remember that price and risk are positively correlated, meaning that as price goes up, risk goes up. As price goes down, risk goes down. That is something that I think everyone always needs to remember about the markets. And this, again, market concentration, something that we have already discussed. And going over to the market overview. So we had over 2,948 stocks advancing on the day, with about 3,349 stocks declining on the day here, and then coming over to where the liquidity was really going to. So this is going to be the heat map. So we did have Tesla up a little bit over 4%, so having a very, very strong day. Amazon down over 1.6, Google was down, Apple was down, NVDA definitely selling off. AMD took a little bit of that liquidity out of NVIDIA, pushing higher after poaching one of their executives. Broadcom, Qualcomm, Texas Instruments. So semiconductor overall was actually pretty strong, with the exception of course, their big name here, NVIDIA, not doing so well. And then Palo Alto Networks down about 2.5%, CrowdStrike down 2.7%, all on the back of Zscaler coming out with their earnings and taking down the cybersecurity sector with it as well. When it comes to the groups, once again, you've got utilities outperforming once again against technology, consumer defensives, and real estate once again tend to lead this market higher. In the last 1 week, as you'll notice, utilities, defensive, financials, real estate continue to be the sectors that are actually leading this market higher. And again, in the last 1 month, financials have done really well. So have real estate, healthcare, defensive, cyclicals, utilities. These are all the sectors that are leading the markets higher. You can also take a look at this on our trading view. So if you come over to the different sector analysis, this is how we performed on the day. Utilities leading up over 85 basis points, followed by staples, followed by discretionary. Then we had real estate, financials, and industrials pushing higher. And the worst performing sectors, energy, on the back of that drop in oil prices that I showed you earlier. Then we had communication services and, of course, technology selling off as well. So if you come over to XLK divided by XLU, and it's only getting worse as it continues to drop. It was down about 1.1%, something that I discussed in our yesterday's update, as this is market's way of getting very, very defensive. This is defensive positioning, folks. This is what the markets do when they are getting ready for a recession, right? We may not see a recession. This is not saying that there is going to be a recession. It's just highlighting the very fact that the market's positioning has shifted very much from being risk on to very risk-off environment here. And we have seen this in the past. Not every time we've seen a recession, but this has just been one of those times where markets are uncertain, right? The word here, the word of the day is uncertainty. The markets hate uncertainty. And when they are uncertain, they move into something that is more safe. They move into safety until essentially the storm is over, until the markets have more clarity about the future moving forward. So that's really where we are with utilities, defensive, staples, continue to outperform some of the more risk-on environments of the market. So XLK over XLP. So if you come over to this particular chart, it will be almost identical to the one that we just looked at. And again, there's been some moments of underperformance on technology relative to the staple sector. And that's exactly what we are witnessing right now as well. Same thing is going to be true for SPY over TLT, so equities over bonds. And once again, you'll notice that this right here was down over 5%, 5% already this month. And this right here has been the significant underperformance for equities, which is S&P 500, relative to the bond market as well. Something that once again is highlighting the very fact that markets are shifting more to a defensive stance in the market. Now, when it comes to MoneyVest Index, now there's a few of them that are now starting to point to some potential buying opportunities. For example, the current VIX level, the contango level between M1 and M2, it's now under 5%. This number's come from 12% down to now under 5%. Volatility is at just over 21.3, so we're in the 68th percentile. The put call ratio is back over 1. We do still have, again, majority of stocks trading above their moving averages. A lot of that breadth is coming from other parts of the market like staples, utilities, financials, energy, real estate, as I mentioned earlier. And the MoneyVest Index is at 3.67. We were at over 4.05 when I issued that warning for all of you that, we're once again well over 4 for the MoneyVest Index. So I think it's really important for us to remain cautious. And we had 2 back-to-back days in the markets that were red. I also posted videos giving you guys a September warning because seasonality is going to be playing a bigger and bigger role. The month of September is not that great for the markets, and we're down a little bit over 2.6% from all-time highs. Not a crazy sell-off, but still something to keep in mind that we are still pretty elevated. Valuations are still well above their historical averages. Technicals, price-to-sales ratios, volatility, MoneyVest Index, there's a lot of reasons why I think caution is very important. We need to be alert, be ready for when the opportunities come our way. VIX spikes further, MoneyVest Index comes down, majority of technical breadth gets taken out of the market. We're seeing a 5, 7, 8%, 10% pullback, or potentially even a correction in the market, and that's when we deploy capital. It's really keeping it very simple. I don't want to overcomplicate it. We're just going to be paying attention to the numbers here, to the quantitative analysis, to what the data is telling us. Recession or not, when the opportunity is there, we take advantage. If there is a recession, yes, it could be a longer lasting bear market and a more severe bear market. So we really want to pace ourselves. We don't want to go crazy as soon as the MoneyVest Index drops below 3 or the VIX is over 50. We don't want to just go all in. We really want to take it nice and slow and steady, have our shopping list ready with the stocks and the fair values and the buy targets and where we want to be selling some puts, and we're going to pace ourselves. So that's the whole plan. That's the whole idea moving forward. And also keep in mind that the volatility historically tends to spike in the months of September and also going into October. So seasonality for not only the market, but also for volatility is pretty high, right? So in the months coming up in September and of course in October. A few more things that I want to break down from our previous updates is going to be things like these, like the summer rally of over 5% has then led to a pretty significant sell-off in October. So more specifically, the last 10 days of October, where we have seen a record of 419, meaning 4 times we've been higher, 19 times we've been lower. So that's been a very, very strong record of an average median change of about 2 to 2.5%. So that is still a very, very significant sell-off, and that's exactly what I'm preparing you for. It's that type of sell-off. And also pay attention to gold. I mentioned this in our yesterday's market update. There's a lot of banks out there that are getting more and more bullish and optimistic on gold. I've been buying gold for well over 2 years. I've been alerting everybody in our Discord. Now again, hindsight 2020, where I could have bought a lot more gold, but I'm happy with what I have, and I will continue to dollar cost average more into gold. I'm always a big advocate of buying physical gold because it's very tangible, it's very liquid. I'm not asking you to just go out there and put every single dollar into gold, but really it's a way for me to diversify a little bit further in times such as like these, where inflation is a little bit more uncertain. We don't really know what the interest rate policy is going to look like, and there's a lot of fear and uncertainty around a potential recession. If there's a US recession, if there's a global recession, whatever the case might be, gold tends to actually perform really well during times of uncertainty. So definitely do consider something like this, whether it's a gold or silver ETF or even physical gold. I think it can really benefit and add a little bit more flavor to the portfolio with regards to those diversification. Now, September cut is coming in. I think that's pretty much a done deal. We'll get more insight into what the Federal Reserve may be thinking, after the jobs report on Friday. And I'm sure there's going to be a lot of coverage all over financial media for what the Federal Reserve may do next after the jobs report come out. But I think at 25 basis points is pretty much a done deal. I think it's really going to be a debate between 25 or 50, depending on how aggressive or strong or soft we come in with the jobs report. So this right here is a good breakdown of the history of the Federal Reserve rate cuts. And every time that's been accompanied with a recession, of course, we tend to see more severe drawdowns, well in the 14, 17, 20% range, as opposed to when we don't see a recession and the market seems to be very much contained within a 4 to 5% sell-off. And in most cases, we've actually been higher 12 months later after the Federal Reserve starts their cutting cycle. So those are some things to also keep in mind. Recession really is the key to where we're going to be. And one last thing I want to mention is, of course, the all-time high of well over 464,000 Americans that are now working 2 full-time jobs. Do not sleep on data like this, because this is really showing us the weakness in the economy. And again, some of the previous reports have suggested that the economy is still strong. Unemployment is low, retail spending is good, retail sales are very strong. But if you really peel those layers and try to really look at some of the core data points, it may not be the best picture, because there's a lot of things that are brewing underneath what looks like a very strong economy, but may not actually be a very strong economy. So that is really what's going to potentially blindside a lot of investors, in my opinion. And if a recession creeps up out of nowhere, then we could really find ourselves in a bit of a troubling situation where earnings start to come down, and markets very much care about earnings. That's really what they care about. They don't care about anything else. If earnings start to decline, if earnings start to come down, that's what's going to put the markets in a very sort of bad footing. And it could lead to lower highs and lower lows and a little bit of a longer lasting bear market, which is good news for us because it'll give us more time to dollar cost average at better prices for individual stocks, for high quality stocks and ETFs and index funds that we've always wanted to buy. And we can be a little bit more aggressive at that point because of the longer window that we're getting to dollar cost average into the market. So coming over to volatility, so down, intraday, but still up on the day, up almost 3%, trading at just over 21. So a nice little spike here yesterday, almost 38%. And pre-market, I think we were trading at well over 23. Then we sold off intraday. So we're kind of perfectly sitting right over there at 23.3. And again, we'll find over the next couple of days here if volatility has any more room to the upside, or we're going to start rolling over once again. Inflation, I expect it to show us some more progress, considering that oil prices continue to come down. For the last couple months, we've seen pretty significant declines. I mean, August was down 6%. September so far is down another 6%. So those are back-to-back, actually 3 back-to-back months for crude oil to come down. So from 3.5% to 6.3% to 6%, it has continued to pull back. And this right here is a drop of a little bit over 15% for crude oil. So that is actually good news, in my opinion, for inflation. Now, coming over to the market, we're not doing very well. And the reason I say that is because we've kind of put in a lower high. So you know what? Let me just break that down over on this chart. And what I'll do is I'll come over to QQQs, and you'll notice that if you come over to the daily chart for the NASDAQ, what we really witnessed was a very simple lower high. So this right here was a previous all-time high, and boom, you've got a lower high on the NASDAQ, right? So that's the QQQ, that's the NASDAQ 100. Now, what's going to be interesting is that whether we kind of find support around here, that's a level that, we kind of consolidate sideways a little bit before finally breaking down. So if the QQQs find any type of support over here, then maybe there's some potential for us to trade back up and retest that resistance here. But in case we get a breakdown below this level, right, for any reason, jobs report, interest rates, inflation expectations, recession expectations, more tech sell-off, NVIDIA not leading the market, the lackluster performance from technology, whatever, right, whatever the case might be, if you do see a breakdown below this, which is going to be roughly around 455, then the next few levels are going to be over here. First one here, all the way down to this level. So those are the two key levels to keep in mind, because I think a horizontal low is a possibility. because that's going to be that support right there. So this right here is still a possibility for QQQs. But really what worries me right now is the fact that we actually made a lower high. So we weren't able to even get up to the previous high here. And again, let alone break out of it. So that's going to be that support level near term. A breakdown could potentially send us down to that horizontal low sitting roughly at 426. And that's going to put us down a little bit over 15% from its all-time highs. Once again, we're going to be in a bit of a correction. I think we're already in a correction right now. We're down over, well, actually, we're in a bit of a pullback. So we're not in a correction fully yet. Correction would be over 10%. So we're down about 8.5. So we're in a pullback right now. So coming over to the 30-minute time frame, that was that more near-term support. So like I said, this right here is going to be that 454, 455 level to keep in mind. That's going to be this, the one that I've just highlighted over here. So bulls need to hold that level. If you break down below this circle, 454, then the next target really is going to be that support from back on Monday, August 5th, which is going to put us down in a correction once again, down over 15% from all-time highs. S&P 500 also broke down from a very critical area of support, so 55.85. So this right here was a level that we talked about in our previous updates. We broke down, and today has been a little bit more sideways to slightly down on a net basis. And 5,400 is a level to keep in mind. And same as QQQs, S&P 500 also failed to take out its previous high. So we actually had a bit of a double top, something that we did discuss in our previous updates. And now the next most important support level is going to be sitting right there. You can see how much consolidation there was for the S&P 500 before finally breaking out. And then we came down, we saw a lot of consolidation sideways once again over here before finally breaking down on the S&P 500. So anything in and around this range, the one that I've just highlighted, is going to be that support the bulls need to hold up. In case we get a breakdown here, then there is a possibility for us to head back down to these levels at 5140, 5100. Now, ideally, I don't want to see a lower low because if we do see a lower low, in case we get a breakdown below this as well, that is really going to be troubling for the markets because then it's going to remind me a little bit more about the 2022 bear market, which is longer lasting, lasted almost a year. And there was a lot of weakness on an intra-week and an intra-month basis for the S&P. So right now, still in a bit of a double top here. And we're coming down to a very important support on the 30-minute time frame. That's going to be at 5,400. That's a level to keep in mind for the next couple of days of this trading week. And resistance is going to stay put at 5570, 5575 as an area of resistance to watch for the S&P 500. So that's going to be the level to keep in mind. Talking a little bit about Apple and coming over to some individual stocks here. Apple continues to roll over. We saw a lot of consolidation sideways and we got a bit of a breakout rolling right back down. Support level, there's going to be a few of them actually. The first one's going to be sitting right over here, exactly where Apple is trading right now. So previous resistance acting as a little bit of a support. And that is where we are at the moment for Apple, sitting roughly at 217, 218. A breakdown below this is going to put us on the map for 207 down to 196, and a resistance all the way up to 236 for Apple moving forward. Talking about Amazon, and Amazon here also starting to really trade sideways on the daily time frame. You can see we were in a bit of a head and shoulders, and support level is going to stay put at $173 all the way down to as low as 166 for Amazon moving forward here. And Tesla had a very strong day, so pushing up from that support of about $207, $208. And you can argue that it's actually making a bit of a symmetrical triangle. So if I come over to Tesla over here, there is a possibility for us to see a bit of a breakout because you've got a higher low and then you've got a little bit of a lower high for Tesla. So, there is possibility for a symmetrical triangle formation here, and a breakout is very much in the cards for Tesla. However, some levels that I would identify for Tesla here, the first one's going to be this right here, and then all the way up to this resistance in the 260s. So those are the two big areas of supply that Tesla needs to take out in order for us to see back up to almost $300. However, I don't want Tesla to be almost at $300 because I sold a call at 300 strike here. But in all honesty, like at $300, I think that's a much needed resistance that we need to take out. Because if you go further back, there's been a lot of supply sitting for Tesla in the 270s, right? So we've kind of struggled to break out over 270s for a very, very long time. So there's a lot of supply sitting right at those levels. So a little bit of a symmetrical triangle formation. We'll find out what happens the next couple of days here going into next week. And like I said, 234, 235, first resistance all the way up to as much as 269. And then, of course, a reasonable area of support sitting right here at low 200s. Historically, acted as a decent support, which turned into a bit of a resistance, which once again turned into a support at around $203. Now, coming over to NVIDIA, and NVIDIA here continues to slide lower. And NVIDIA also very similar to QQQs, also formed a bit of a lower high. So what you'll notice over here is, unfortunately, it has been making lower highs for quite some time. So we got a lower high here. We've got a little bit of a lower high over here. And then finally, one more pretty severe lower high over here for NVIDIA. And really the ideal thing would be to find some type of stable support in and around these levels so that we can actually mark out a higher low. So this could be argued a bit of a higher low. But if you don't see that, if the selling pressure does not exhaust, if there's no buyers stepping in, then there is a possibility for us to make a lower low, which at which point is not going to be good news for NVIDIA, because we would be very clearly in a bit of a downtrend from both a lower high and from a lower low perspective. So this right here would still be considered as a bit of a downtrending pattern for NVIDIA. So really the ideal scenario would be to find some type of support sort of in and around these levels. Anywhere here would do if buyers step in. But if you break down below the Monday's low, which is, $90 a share, then you better believe it, there's going to be more pain, not just for NVIDIA. We're talking for the entire market, for technology, for semis. There's going to be more pain in the cards for the entire market. So I think it's really important for not just NVIDIA, but really just the markets, QQQs, S&P 500, for Tesla, for every stock that I'm going over, to really find some type of support. That's really what the bulls need to hold up. If they don't, then we're just really opening ourselves up to more vulnerability and more selling pressure to the downside, because we'll be marking a new lower low. And that would just take out Monday, August 5th's low as well. And that's not going to be good. That's a lot of weakness in part for the bulls here. Now, coming over to advanced micro devices, and AMD actually did see some decent gains after yesterday's spanking. It was down a little bit over 7.8% as all semiconductor stocks were down. However, I would still argue that we are still very weak. As you'll notice that we are very much, on par with NVIDIA's lower highs and lower lows. And you can see that this is the clear downtrend that we're also witnessing for advanced micro devices. So the next support really is going to be down at $101, but similar to what we just witnessed for NVIDIA, there has to be some support sitting right there, considering previous resistance, and another support here. So if you do find any type of buyers stepping in around 127, 128, maybe there's still hope for advanced micro devices. But in case we get a little bit of a breakdown below this level, then unfortunately, there's possibility for us to get down to low 100s for advanced micro devices as well. Talking about PayPal, and PayPal here still very, very elevated with a very nice rally, getting up to over $72. It's actually been outperforming the entire market. So this right here is going to be that chart for PayPal on the daily, and support level is going to stay put roughly here inside this green rectangle, something that we have discussed in our previous updates, and the next target and resistance all the way up to as much as $76, $77, and a lot of consolidation sideways for PayPal around those levels. So again, very overbought as well. So just got to be very, very careful. Visa continues to see a lot of inflows. It's actually one of those companies that is outperforming the markets very well. As markets continue to come down, we're seeing Visa continue to push higher. RSI, MACD, all very overbought right now. So just got to be very careful with where we are at the moment. And resistance is going to be all the way up to $282 with a support level now sitting at $272 for Visa moving forward. Talking a little bit about Meta platforms here. So Meta, we're going to come back over to this chart, starting to roll over, but up over 19 basis points right now. Huge area of supply, and resistance stays put at $540 with a massive support sitting in the 450s, down as low as $420 for Meta as well. Netflix here also rolling over just a little bit. Resistance stays put at close to $700, and support level is going to stay put at $663 for Netflix. And Google, Microsoft also struggling quite a bit. We talked about the bear flag breakdown for Google, and the next support really is going to be down at 153 for this company. So that right there inside this green rectangle is going to be that area of demand for Google at the moment. A resistance, we're going to go ahead and turn this level into a resistance right now for Google, which it's struggling to break out of in the 160s. And then finally coming over to Microsoft, and Microsoft also well within this head and shoulders pattern. And I would argue that there is a possibility for us to see a little bit of a breakdown from this neckline, which is sitting roughly around $400. So if you do see a breakdown below this, of course, sub $400, so it's possible that we get down to as low as 350s. That's where the next area of support would sit. Maybe you could argue there is some area of demand here in the 365, 364 levels, but that right there is where and how Microsoft is trading. Finally, coming over to Enphase. Enphase seeing a little bit of relief on the day, but still selling off quite aggressively here the last couple of days. A lot of consolidation sideways in that range. Support level is going to stay put at $97, $98 as we have discussed in the past, and resistance all the way up to 142, and another near term resistance sitting roughly at around 120 to as much as I would argue about $124, $125 per share. And finally, we come over to Costco. And Costco here pushing up over 1.3 back up to $890. And that is where the resistance is, right over there at close to about $894 for Costco. So hope you all enjoyed this video and a complete update on the markets. Make sure that you drop a like and subscribe to the channel. The bottom line is that we've got lots to unpack later this week with the unemployment numbers coming out. So let me know your thoughts down in the comment section below for what you are expecting from the jobs report for later this week. Subscribe to the channel and also do join our Discord and our Patreon if you're interested with that 16% annual discount with 4 more spots left if you want to snag a spot in September and join our community. As always, happy investing. I'll see you all in the next video.